Good morning, everyone. We'll be starting in a couple of minutes. Just a quick sound check. If you can hear me okay, can you please type a 1 into the chat window? Okay, seeing a few ones. Thank you. Yeah, we'll start in a couple of minutes. Okay, let's get started. Good morning and happy new year, everyone. All the best for 2023. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be walking you through how I'm viewing the current market. So before we get started, just the usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, starting off with the major indices, highlighting what my view is for the next few weeks, and also just briefly going through how price action has behaved in the last during the Christmas period. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today. And we'll end today's session with some bullish and bearish market observations. So before we go and start looking at the major indices, I want to take a look at the Fed rate hike probabilities. And last year was a very hawkish year, no doubt about that. We saw interest rates rise quite rapidly, a lot of 75-point moves happening in a very short space. And now we are seeing that is decelerating. We had a 50-point move the last time a few weeks ago. And for the next Fed meeting, which will be on February 1st, we are pricing in what's likely going to be only a 25-point move. The current target rate is 425 to 450, and a 25-point move will take rates to 450 to 475, while a 50-point move will take rates to 475 to 500. And if we look at the probabilities of a 50-point hike, it's only at around 28% compared to 72% for a 25-point hike. So Fed futures are definitely pricing in a higher probability of a less aggressive rate hike. That being said, it's a month until Feb 1st, and a lot of things can happen. We have one jobs report on this Friday, and we also have one inflation reading as well before that Fed meeting. These events will happen in the next couple of weeks, so I do think that there'll be plenty of time after these events happen for markets to price in before the next Fed meeting. So that is one important thing to just to know. But for now, 25-point hike is on the cards. And how is that impacting equities? Well, if we take a look here at the S&P, fairly quiet Christmas period. The last few days, last 2 weeks really have been had a very neutral tone. Price has definitely been consolidating during this time, especially after that December decline, after the Fed basically stated that rates would be higher for longer than originally anticipated, or longer than what markets were pricing in. So that wasn't very good news for the bulls, and that is why we have seen that decline last month. But overall a good bit of consolidation over the last couple of weeks. Price is set to open a little bit higher this morning. Looks like we are starting the year off in a more risk on tone. Let's see how long that lasts for, because our view for 2023 is going to be somewhat turbulent. We obviously have further interest rate hikes, but on top of that, we have a lot of recession fears induced by higher interest rates. And for that reason, I wouldn't say this risk on tone that we're starting the year off is going to be around for very long. There is still a lot of clues as to why it makes more sense to be focused towards value as opposed to growth. And looking at the price action here, you kind of see that price is still struggling to break above that 403 level, despite that initial rally heading into December. And right now, price is at that 380 area, finding support. Even though it's moving a little bit higher this morning, I don't think that means much. To see a bullish breakout, I'd like to see price actually break above this 390 level, minor support level in the past. And if we get a breakout above there, that would open the door for that 404 area once again that price was reacting to. But we still don't know how much momentum there is. I mean, let's put it this way. I don't believe there's that much momentum in this move higher this morning. And right now, it still remains in a more bearish tone, despite this risk on open to starting off the year. If we take a look at the NASDAQ 100, we look at the S&P 500, it's still quite far away. There's still a good bit of distance away from that all-time low. Oh, sorry, I should say 2022 low. But NASDAQ 100 is a lot closer towards its 2022 low. And that obviously speaks to the fact that NASDAQ 100 is a lot more exposed to technology names. However, I do think that 2023 will be a year that technology will start to gain a bit of ground. We're seeing some initial clues, and I'll discuss it further when we look at the sector rotational chart. But I do think that technology should fare a little bit better, despite the recessionary fears. It should fare a little bit better this year, as the pace of interest rate hikes are going to be slowing down. But for now, the first 6 months of 2023, I am still expecting, bit of turbulence. Maybe not as much of a bear market as we got in 2022. We know bear markets tend to only last around 6 months, and I think we're past the worst of it. But doesn't necessarily mean we are in store for a big bounce and a big recovery. There's still a lot of economic factors globally that are quite negative, that are essentially saying that global growth is going to be somewhat stagnant due to higher interest rates from all the major central banks. So that's something to keep in mind. But keep an eye out on technology names. I do think there'll be some opportunities within that space. NASDAQ 100, though, back at the 260, between 260 and 270 level, set to open a little bit higher, just below the 269 previous area of support, but I would consider that to be still a weak area of support. It's more about this area between 260 and 270. That is the area of support that we'd be focusing on. That price is currently bouncing off of once again. Moving on to small caps, looking at the IWM Russell 2000, and we have some interesting price action here. So overall, definitely a bearish trend in the last year, over the last 12 months. Price did make a double bottom at 163 on the weekly time frame, and came back to that 38.2 fib level at 188. This is a major area of support and resistance. Failed at that level, and you can see on the daily time frame actually moved lower back down to 170, where it is so far finding some support. If you look at the last two candles on the weekly time frame, we are seeing strong intra-week bounces from that 50% fib level at 170. So the price is still, managing to stay above 163. That doesn't look like price is heading towards 163 just yet, and set to open a good bit higher at around 175. So in looking at this price action, it does indicate that maybe we could see a bit more range bound markets, potentially small caps starting to gain some ground relative to large cap names. We saw clues towards the end of last year that small caps were improving in terms of relative strength against large caps. But let's see how that plays out over the next few weeks, because right now there is still a bearish tone here, and price that did fail to make a new higher high last time at 188. So for now, it does look like 188 is holding it as resistance and 170 is holding as support. And moving on to the VIX, and what I find interesting about the VIX, especially in the last, I would say 2 months or so, is this decline. Potentially longer than 2 months, but we've seen the VIX decline all the way back down towards between 19 and say 24, 25. And that is a huge positive in my opinion, not because a lower VIX necessarily always means stocks are going to move higher. I'm looking at this as from more of a correlation perspective. When the VIX is high, especially near 30 or above, like it has been for quite a long time in 2022, we saw there was this strong correlation across the board. There was strong systemic risk and strong correlation between all the stocks. So it made technicals, looking at the technicals and the fundamentals of individual companies, it made that very difficult, because the price action was simply going to follow what the overall market was doing. However, when the VIX is lower, like it is now, we tend to see less of that broad-based correlation, which makes it easier, which makes trading conditions a lot easier. So that is probably the biggest reason as to why I'm excited about this year, is because we can actually trade a bit more. We can diversify our portfolio or diversify our trades a lot more with the VIX being as low as it is. And despite the last month or so of declines in December for the S&P, the VIX hasn't exactly spiked. It's actually stayed below 25, hasn't really closed above 25 during that period. So that again is a huge sign to say that yes, even though we experienced a decline and the VIX did move a little bit higher as you would expect, it didn't spike up all the way back to 30 like it was during 2022. So lack of correlation, huge positive heading into 2023. And in my opinion, easier trading conditions despite the more bleak global economic outlook. Okay, taking a look here at TLT, the bond ETF. TLT, saw a significant rally in the last few weeks from November onwards, really, in 2022. But bearish structure still remains. I mean, if you take a look at the weekly time frame, it was getting primed for a rally with price being in a heavily oversold condition. Sure, it moved a little bit higher here, but we can still see this is still a new lower high. And bearish structure remains intact. A lot of bearish price action on the weekly. However, this morning on the daily, we are seeing a little bit of a gap higher. Overall thesis does remain neutral with a bearish bias. We know that it's looking like interest rates will cap out at around 5% level, unless something drastic happens at looking at the economic numbers. But we have some certainty as to where interest rates will be going in 2023. So for that reason, I do think TLT will find some support, potentially 92.50 being the bottom. But there is still a lack of an upside catalyst, because if interest rates are going to be elevated for an extended period of time, you can't expect bonds to move higher. So for that reason, neutral to bearish bias here for TLT. It is set to open a little bit higher this morning. And potentially, if it does continue to rally back to the 110 level, that's where I'd start to be looking at some bearish price action for a better risk to reward bearish entry points. Now, taking a look at the dollar, big move this morning for the dollar. Recessionary fears as well are kicking in. So on one side, we do have a risk on opening. Normally, when stocks move higher, we tend to see the dollar move a little bit lower. However, that has not been the case so far. So we are seeing stocks move higher. We are seeing the dollar move higher. And this might be a clue as to the next few months. We know that Europe is having a bit of a crisis with consumer spending. Obviously, the energy crisis is going to dampen consumer spending across the board. and investors are naturally going to flock to a more safer currency. So dollar finding some momentum from that 103.50 level, approaching that 105.50 area of resistance. And if it breaks above that, you're looking at its 55-day exponential moving average, or even potentially all the way to 107.50. Let's see how this plays out over the next few days, but we are seeing, a few clues as to capitulation for the dollar, increasing momentum, despite price decreasing. And overall, that the more recent weeks have seen more choppy price action as opposed to a strong decline. So we may see the dollar continue higher, especially if what the Fed says is true, with interest rates being higher for longer. That would be a bullish case for the dollar. Now, when it comes to gold, and I'm sure you've all heard me say this a million times, how gold moves inversely to the US dollar. When the US dollar moves lower, gold tends to move higher, and vice versa. However, we are not seeing that today. We are actually seeing gold continue to move higher, despite decreasing momentum after that initial strong rally. Gold did pull back towards the 21-day exponential moving average, but has continued higher and is continuing to find support at its 21-day exponential moving average, set to open high again this morning. That does indicate that there is rotation into gold. And remember, gold is a safe haven. So this may provide a clue as to what institutional money is rotating towards. We might have a risk-on environment now for the short term. However, if gold is continuing to move higher, despite the dollar increasing as well, that would indicate that investors are still preparing for more turbulent times and are naturally flocking towards a safe haven asset like gold. I would say gold would have to break above 170 for that thesis to really kick in, because if it does, we can see that there is a clear run back to 174, which is a minor resistance level, as well as 177, which is a more major resistance level. So those would be the two key areas of resistance for gold. But overall, what I want you to take away from this is the fact that gold is moving higher despite the dollar moving higher as well. And we don't often see that. And taking a look here at oil. So oil thesis from the last market outlook session on December 20th, that remains intact. And that thesis was neutral, with 63 acting as support and 71 acting as resistance, and price to be range bound for now. So on one hand, we have the revamped COVID laws in China and essentially the quote unquote reopening of the Chinese economy, which is driving price higher. Not because China is a huge consumer of oil, and naturally more demand creates a higher price. But on the other side, we also have recessionary fears, which will naturally act as a headwind for oil, driving price lower. So that's the current tug of war that we're currently in. And those would be the two major factors dictating price in oil. So for now, I do think that until something changes, until we get some key economic data points to state otherwise, I do think that USO here will be between 63 and 71, so fairly range bound here. The other thing I want to point out was that the energy sector in 2022 was a very strong performer, right? And I do think there's going to be a lot of rotation out of that sector heading into 2023. Even if oil prices continue to move a little bit higher, they won't do so with as much momentum. I think that rotation that we saw inwards towards energy may start to lose some steam and heading into 2023. Okay, taking a look at the sector rotational chart, we are seeing good bit of rotation here in the last couple of weeks. Again, energy providing a lot of leadership throughout the year, losing that relative momentum, heading towards the weakening category as oil prices start to consolidate a little bit more. But we do have, we have financials, we have healthcare, we have staples, we have industrials, and we have materials, all in the leading category. Our defensive sectors in healthcare and staples The two or three defensive sectors are still in the leading category. However, healthcare is losing some relative momentum. I wouldn't read too much into this. If you actually look at a lot of the healthcare names, they've been performing so well in 2022, especially towards the end of the year, that they are starting to pull back a little bit, and that's completely understandable. Staples are staying strong. And if we take a look at the third defensive sector in utilities, look at the momentum in the recent weeks. Heavily in the lagging category as high interest rates made municipal bonds less attractive. But ever since we got the news about, the lower rate hike increases, we are seeing utilities gain some relative momentum here and actually rotating back into the improving category. So keep an eye on these defensive sectors. I do think they're going to play a pivotal part in 2023 strategy. We have in the lagging category, communications pretty much stayed there for almost the whole year, rotating between lagging and maybe slightly improving. But we have discretionary, and this could be a potential, a potential medium to longer term bearish play. So we know that consumer spending is naturally going to decrease heading into this year. And discretionary is heavily reliant on consumer spending. So with consumer spending decreasing, it's no surprise to see discretionary already in the lagging category. And my hunch is that this will continue to at least underperform the overall market. We also have real estate making a bit of a comeback. And interestingly enough, we have technology. Not a lot of momentum behind this move, but it is rotating into the improving category. Now, the fact that technology is not in the lagging category and it's finding some upward momentum, that indicates that there are certain names within that sector that may provide bullish opportunities. And I'm talking short-term bullish opportunities. We know the likes of Apple, Microsoft, these are names that are always going to be long-term bullish due to the quality of product and their diversification of product that they have. But there are other names within the sector that, experienced a lot of pain in 2022. And technology across the board experienced a lot of pain. But now we are seeing that that lack of correlation within the sector, and we are starting to see some short-term opportunities for technology because they've sold off so heavily that they're all in oversold conditions, much more respectable valuations. So it does make sense to see some potential short-term bullish opportunities here for technology. I wouldn't go all out bullish on the sector just yet. We need more relative momentum. We need more relative strength, but we are seeing an improvement, no doubt about that. Okay, taking a look here at some subsectors of interest. And the first one I have here is KWEB, which is a Chinese internet ETF. A lot of these subsectors that I'm showing you today, or all of them, were actually the same ones that we covered on December 20th, but they were all on my watch list for different reasons. Now, I am looking for a bullish play within this subsector, and the reason for that is that it provides some diversification away from US securities. Now, we saw a significant rally here for KWEB breaking above 27, finding some resistance at around 32. And I was looking for that move lower back down to 27 for a nice risk to reward bullish entry point, which was a previous resistance area, also a previous support level. So that would have given more ideal bullish entry point. But, I will say the fact that price is staying elevated at this level, although it's consolidating, it does provide a tempting move to the upside. Because if we take a look at the weekly time frame, it provides a much clearer picture where you have a strong move followed by 4 candles of consolidation, not moving lower. And, we could potentially see a breakout above 32. And if we do get that, that opens the door nicely, not only for 35, but even 40, which is a more major resistance level. And with the Chinese economy starting to gain some momentum, I do think that Chinese stocks could be, at least for the first few months in 2023, a good potential bullish play. Taking a look here at XHB, which is the home builder ETF, And our thesis for this was that price stays above 60 and, you look for credit spread opportunities in this type of market. And overall, I'm still a big fan of credit spreads in this market. Traditionally, you'd only want to use credit spreads during times of high implied volatility when the VIX is higher because options become more expensive and therefore you get more bang for your buck. But I still think when you look at the strategy for credit spread, and if you consider the fact that there's three key trends in the market, there's a bullish trend, bearish trend, and a neutral trend. Credit spreads benefit from two of the three trends. They benefit from a neutral trend and from a bullish or bearish trend, depending on the type of credit spread. And that it's very forgiving strategy. And for that reason, especially now at a time of still quite a bit of uncertainty, we're still expecting a lot of neutral price action across the board. I do think that credit spreads do provide an ideal, a more tactical way of playing the markets over the next few months. And it allows you to essentially be able to profit from neutral price action. So looking at XHB, we are seeing price staying above 60. Yes, there's some limited upside, but overall, from a relative performance perspective, it is outperforming the overall market. And the fact that it's staying above 60 does provide some optimism for at least a move higher back up to that 63 level, which has acted as resistance on multiple occasions. And finally, KRE. So KRE was another name that I was looking at last year because of this heavy sell-off breaking below that $60 area of support. We saw that price did approach an oversold condition, and we were waiting for a move higher, retracement higher, potentially back up to that 60 level, where if we see any bearish price action, we'd be looking for a good risk to reward bearish entry point. We haven't seen that bearish price action just yet, but so far we are looking at price moving a little bit higher towards that $60 level. And if you see bearish price action there, I'll be looking for a good risk to reward bearish entry point for a move lower, not only back down to 56, but a secondary take profit would be at around 54. As you can see on the weekly time frame, that's the next key area of support. So a bit of patience required, but in my opinion, KRE still on the watch list for that bearish opportunity. Okay, taking a look here at some market observations. This is actually a bearish market observation in General Motors. This was a name that we've covered for a few weeks. And our thesis for this was that price would stay below 40. And that has held up quite nicely. In fact, if this was a trade you did take, it's definitely time to take profits, in my opinion. We saw a strong decline and actually break below 37, which was a bonus for us because I wasn't really expecting price to necessarily break below support. I was just expecting it to stay below resistance. So because of that, and because of the fact that price is now reaching an oversold condition and recovering, it makes sense to take profits on this trade. JP Morgan, new idea, and it's actually a bit of a play on higher interest rates. Now, traditionally, banks perform well in a higher interest rate environment. We didn't see that because of the decline across the board, hence this strong decline in 2022. But now, more recently, we have seen a lot more momentum back into banks in general. Price breaking above 127. Couldn't really move higher, so pulled back towards that area of support, found support, and it's now moving higher once again. So a nice initial move higher, followed by some exhaustion, and now gearing up nicely for a continuation, for potentially a second leg. I'd be aiming for 140 as an upside target for JP Morgan. You can see it has acted as resistance in the past. And also another reason I'm targeting JP Morgan specifically, it is by far the best performer in terms of major banks. So if you compare it to Goldman Sachs, Morgan Stanley, Citi, JP Morgan has performed very, very well relative to those names. So that is why I am looking here at JP Morgan. Okay, taking a look at Intel. Intel, another name that we covered on December 20th. And this did move lower. It was a bearish idea that did move lower, but hasn't really moved lower by that much. So, if this was a credit spread, yep, it would be a profitable credit spread with time decay working in your favor. But if you were in this trade, I do think it makes sense to actually get out of this trade now. It is finding some momentum We can see momentum is starting to increase. Price action is moving a little bit higher. So no need to stay in this trade despite the weak technicals and weak fundamentals. Okay, taking a look here at Monster, part of the staples sector, another name we covered a couple of weeks ago. Thesis was that price would stay above 100. And, since that Tuesday, December 20th, it has stayed above 100 and actually has moved a little bit higher. So again, if this was a credit spread, and it's worked in our favor, I do think that this will be a profitable trade, even though price didn't move that much higher from that Tuesday open. It's only moved, I would say, about $1 higher. But again, credit spreads in this type of environment are ideal. And as for Monster, this would probably be a trade that you want to take profits on already, just because there's a lot of upside momentum, and theta has worked in your favor now for a couple of weeks, so it makes sense to kind of get out of this trade and move on. And finally, we have Dexcom. So Dexcom, this is an interesting idea and really speaks to the fact that even though it's technically a health company, it's one of the higher beta health companies, kind of trades very similar to a technology company. It's definitely in like the growth segment of healthcare. And if we can take a look at the price action, ever since this gap higher from 104 to above 110, price has found support at that 110 level. And it continues to find support there. Even more recently, we're seeing a few intraday bounces, and this is a good risk to reward to play the range for that move higher back to potentially 124. And this would just be a range that I'd want to play to the upside and to the downside here for Dexcom. So good risk to reward, bullish entry point. But again, the strategy that I'll be using here would be a credit spread. Okay, and with that, that is all I have for you today. Thank you so much for joining me, and I will see you next week. All the best for 2023, guys. I hope the trades go well this year.